What's going on, guys? Welcome back to another episode of Trading from Scratch. So far, we covered things like market structure, liquidity sweeps, and how to read the chart. Today, we're going to be talking about fair value gaps. This is one of the most talked about concepts in trading, but also one of the most misunderstood. A lot of traders think every single fair value gap is an entry, but that's not how I use them. And I think you guys should take it from me. I just requested $7,500 out of my Top Step accounts yesterday. So in this video, I'm going to show you what a fair value gap actually is, why they form, and how I personally use them to continuously take money out of the markets. Don't forget to like, comment, and subscribe if you enjoyed the video. And guys, check the description of this video. I have my Discord server that is currently a growing community. Make sure you guys join that if you guys have any questions, if you guys want to relate and talk to other traders, as well as just share progress and wins. All right, guys, let's get straight into it. All right, guys, let's jump straight into it. So fair value gap is simply an area where prices move so aggressively that it left behind an imbalance where buyers and sellers were, okay? So in dummy terms, it's basically when you have three candles in a row like this and both of the wicks, right? Remember, these lines on these candles are called the wicks. So this is a wick, and let's do the same thing over here for you guys. This is also a wick, okay? So looking at those two lines, we see now, okay, there's a gap between these two candles, and this is what you call a fair value gap. So you would mark out from the top of the third wick to the bottom of the first wick, and that is your gap. That is the imbalance that was created, and that is what a fair value gap is. So now a validated fair value gap is one that we're looking at right here. So if you guys look closely, we actually entered inside of the gap and then came out. This is a fair value gap that was respected. We will have a separate video on ones that are disrespected and what they are called as well. So we know that this is a fair value gap because we tapped into it with this original candle right here. And we also came out of it having a what, guys? We talked about it, a break of structure. So if we mark out from this candle where it entered, we can clearly see, guys, we have a break of structure out. And this is a confirmation that you guys have just learned. This is what a fair value gap is, and this is what it looks like when we get a validated one. All right, guys, so just looking at these candles right here, where is the fair value gap? All right, so let's look where we have three candles where they create a imbalance. Okay, we have an imbalance right here to here. Okay, so this is a fair value gap. And I don't want to confuse you guys. There's also one up here as well, right? If we scroll up, there's also one right here. This is a very, very small one, but that is also one right there. For any of you guys are looking at that and saying, wait, isn't that one as well? Yes, but we're looking at one where it had a reaction off of. So we have a fair value gap and we enter it and we break out. Now let's get our line tool and see exactly where we actually entered and where we would have to break out. So that is right here from this green candle. So to break a structure out of it, we would have to break this sort of structure with a close out with a bearish candle because it's a bearish fair value gap. And that is a confirmed fair value gap that was respected and validated. And this, once again, is a confirmation. And I'm saying that on purpose so you guys know that this is a tool that, we're actually learning that you can use for a strategy. All right, guys, now I'm going to show you guys an example of when we just have the wick go inside of the fair value gap box. So, okay, let's look within these candles here. Where's the imbalance? All right, we have a wick down here, and then, oh, there's a big gap in the circle. So what do, guys? We mark out our box tool from the top wick of the third candle to the bottom wick of the first candle for bullish. And this is a fair value gap. Now let's see if the fair value gap was respected or disrespected. Okay, it was respected. We tapped into it and we had a break of structure out. Now, yes, this is still a valid fair value gap, even though we did not close inside of the gap, because the wick is enough for us to understand that price tapped into it and we have a break of structure out, and that is a confirmed fair value gap. All right, guys, I'm going to start speeding things up a little more because you guys should be getting it by now. But here we go, a fair value gap to the downside where we just wicked inside of it. So as you guys see, came down, came up with this green candle, we wicked inside of it, and then the imbalance was right here from these three candles. And this is where we would have to break structure out, and we break structure out. And now moving on to the next part, let's see what happens when we break structure out. So we broke structure out, and you would have to have a really big stop loss for this. But as you guys see, we continued to go down after breaking structure out of that fair value gap. Fair value gaps are a confirmation tool, and these are once again tools you can use to build yourself a strategy. and put the pieces together. But don't worry, guys. I'll show you guys how to do that so you guys have a back-tested and trustworthy strategy that I use. So now let's look at some examples of market reacting to it. Now that you know what it looks like when they are respected. Okay, we have an imbalance right here. Why? Well, we have candle 1, candle 2, candle 3. Candle 1 and candle 3 had an imbalance in between candle 2, which created this box for the fair value gap, and we tap into it right here. Why is this not a tap into the fair value gap? Well, because it's a bullish candle. Now, technically, we could probably scale onto the 1 minute and find a bearish entry on here, but on the 5-minute time frame, this is the real entry, okay? Do not get that confused. So we mark out the line of where we would have to break structure out, and we break structure out basically by, and sorry about that, I meant this one, and we break structure out with this green candle right here, and that is a confirmed fair value gap. And what happens, guys? We end up going up afterwards, then eventually back down, but notice that we were able to go up after confirming it. All right, guys, we have a really good example right here. So looking at these candles, tell me where the fair value gap is at. All right, I'll wait. Yep, that's going to be between these 3 candles. If you're still confused, I'll mark it out for you right now. Don't you worry. All right, so we have a gap between these 3 candles. You know, this is one of the easiest confirmations to understand, guys. Do not overcomplicate it. It's just 3 candles and then an imbalance in between those 3 candles, or just space in between, right? You know, I don't want to use fancy words. And that's pretty much all it is. So the first original entry was right here. But as you guys see, even just how market tends to react, you know, we come up, come down, come up, come down, you know, come up, and then we eventually end up breaking through. Once again, there will be a separate video because that in itself is a confirmation as well when we invalidate it. But that one was also reacted off of in a good way. All right, guys, so now we're going to show you 2 or 3 examples of just putting the pieces together. All right, guys, so now we're going to show you guys 3 examples of putting the pieces together on how we can use liquidity sweeps and just liquidity in itself to connect to fair value gaps. All right, so we have a swing low down here, right? Now, what tends to happen on this one? Well, we don't actually get a sweep outside. Remember, a sweep means we're going up. If you don't know what that is, watch the last video where we connect all market structure things that we went over so far. But we get a break out of this, which signals, you know, once again, watch the last video, but this signals that we were going to go down. That's exactly what happens. So we go down, guys, and then actually what do we get? We get a fair value gap. Now, at this point, we can even use this as more confirmation. So we already have this market structure signal that we broke through this swing low. So we most likely want to go low. So we may not know how low we want to go. So we may say to ourselves, let's wait for some sort of confirmation. And what do we get, guys? We get a fair value gap. We tap into it. Where would we have to break structure out? We'd have to break structure out off of this open right here. And this is where we close. And that is one way you could put the pieces together. Now, I know you guys are saying, wait, you didn't continue to go down afterwards. Well, we went down so much that by the time we got this fair value gap and closed out, market didn't want to continue going lower after taking out this liquidity. But it just shows you guys how we could put the piece together. But let's look for some examples of things actually happening in a more clearer way. All right, here you guys go. We have another example here. Swing low. We end up closing through this liquidity. So that's already sign 1 that we may want to go lower. Now, once again, let's say, all right, let's wait for some sort of confirmation to see if we want to go lower. And what do we have? We have a fair value gap right here. And we tap into it with this green candle right here. Okay. After that, let's mark out where we would have to close past it. And that would be this line right here. We close past it. And then at that point, we could enter the trade and we continue to go lower. This is a confirmed fair value gap that was connected through a breakout from liquidity. All right, guys, this is a little bit of a more advanced example, but just pay attention to these candles right here. And I'm going to show you guys how we had a liquidity sweep that also reacted with a fair value gap. So where do we have liquidity resting? Well, it's all over, but let's just show right here. Okay, we have liquidity resting right here. You can clearly see the sweep. Why? Because we came up and came down through the liquidity. But let's also look. There's also something happening right in front of our eyes. We have a fair value gap that's forming right here. And what happens? We actually tap into it with this green bullish candle right here. And then afterwards, we break of structure out of it. So remember, guys, we are not connecting break of structure and fair value gaps to show you guys the confirmation that we may want to continue lower. There's no guaranteed, but we just may want to continue lower. Stop loss maybe is up here for whatever reason. Stretch it out just to show you guys. So yeah, price went through negative for a little bit, but then we ended up returning back down due to this original sweep in liquidity plus the fair value gap confirmation. All right, guys, pay attention to these candles right here. Once again, this is a little bit of an advanced example, and it's only advanced. The reason I say that is because there's a lot going on and they're very choppy, but just pay attention. Okay, starting from left to right, where do we see a fair value gap? Tick, tick, tick. All right, right here. Okay, so we mark this out. We stretch it all the way out. There's no rule to how long you can stretch out fair value gap. Obviously, am I going to take out a fair value gap from freaking 2024 and stretch it out and say we're reacting? No, but like, you can't be too strict with yourself. Like, so you can use a fair value gap that doesn't really get respected until maybe an hour or two later, and that's okay, right? And this one, yeah, it took like 3 hours to get respected. But look, we have this fair value gap. Now, where do we have resting liquidity? Okay, let's lock this real quick. We have resting liquidity swing low right here. Okay, what happens? Well, we actually tap into this liquidity as well as the fair value gap, guys, and then reverse up. Do you guys see how you're putting the pieces together? So understand that the break of structure out as well as the fair value gap are your confirmations. And then the liquidity sweep is just market understanding. Market understanding is different from things that are confirmations and concepts. Always remember that, okay? But all right, guys, I feel like I've shown you guys enough. So that's pretty much fair value gaps for you guys and how you can connect them to liquidity sweeps and how, we use break of structures to confirm those fair value gaps. So that's the basics of fair value gaps. And remember, guys, don't think of them as magic entry signals. Just simply think of them as another piece of the puzzle. The more concepts you can stack together, the more A+ quality setups you will be able to take. Stay tuned because in the next episode, we'll continue building on these concepts so you guys can see how everything connects to one bulletproof trading strategy. If you enjoyed the video, don't forget to leave a like, comment, and subscribe. And don't forget to join the Discord, link in the description. And I'll catch you guys in the next one. I love you guys. Stay blessed. Peace.